Unlock the future. Big changes have just redefined how we build and protect generational wealth in Kenya. If you've ever considered setting up a family trust, or already have one, these new laws will change everything you thought you knew. Kenya's legal and tax frameworks have progressively evolved to support the establishment and operation of family trusts. These developments provide individuals and families with robust tools for estate planning, asset protection, and intergenerational wealth transfer, while offering significant tax advantages. In December 2021 and March 2022, Kenya made two game-changing legal reforms that finally gave family trusts the power, permanence, and professionalism they deserve. These aren't small tweaks, they're structural shifts that open the door for real legacy planning. Let's break them down. Trustees, Perpetual Succession, Amendment Act, 2021. The first was the amendment to the Trustees, Perpetual Succession Act, cap at 164, enacted on December 23, 2021. This formally recognized family trusts as distinct legal entities. It also streamlined the registration process, so now incorporation can happen within just 60 days. But most importantly, it gave clarity on how family trusts should be structured and why they exist to preserve and protect family wealth. Perpetuities and Accumulations Amendment, Act Number 10 of 2022. Then came the second big shift, the Perpetuities and Accumulations Amendment Act, Cap 161, enacted on March 21, 2022. This removed two major limitations that had held families back. The 80-year rule, gone. Now, a family trust can last indefinitely. Restrictions on income accumulation, lifted. You can now preserve wealth across generations without legal time limits. What does this mean? It means your trust can now own land, company shares, money markets, and any other asset forever. Stamp Duty Act, Cap 480. Let's start with stamp duty. Normally, transfers of property attract duty, 4% for urban land and 2% for rural land. But there are key exemptions for family trusts. Section 52, 2B. If you transfer property into a registered family trust as a gift or voluntary disposition, no stamp duty. Section 52/6. Later, when the trustee transfers that property to a beneficiary, stamp duty is also waived. This makes it easier to move land or assets into, and eventually out of, the trust without huge tax. However, always consult with the tax authorities at every step. Income Tax Act, what changed in 2024. Now this is where things get interesting. Under the Finance Act 2021, two major tax exemptions were introduced. Section 13. The income and principal of a registered family trust was tax exempt. Section 11(3)(a). Distributions to beneficiaries were exempt if used for education, medical, or housing, and under 10 million Kenyan shillings annually. But in 2024, these sections were repealed. What does that mean? Now, income earned by the trust is taxable if it's not distributed. If it is distributed, beneficiaries may be taxed based on their personal tax profiles. This is a significant shift. It means family trusts must now think more strategically about how they earn, hold, and distribute income. To recap, you can still save on stamp duty and capital gains tax if you're properly registered, but don't assume income is tax-free. Those exemptions are gone. Professionalism matters now more than ever. Work with your tax advisor, register your trust with KRA, and consider a family office to stay compliant. Family trusts in Kenya are now designed for the long game. With the right legal framework and professional coordination, your legacy isn't just protected, it's positioned to thrive. The future of legacy planning in Kenya is here. The laws support it. The tax code recognizes it. The question is, are you structured for it? If you learned something today, hit like, click subscribe, and let us know in the comments. How are you preparing to structure your family trust for the next generation?